third quarter saw a continuation of the headwinds facing the global economy. Inflation remains a key concern, and fears around a recession continue to grow. Europe's energy crisis looks set to continue, and the war in the Ukraine shows little signs of easing. Central banks globally remain hawkish, and the ongoing rate hiking cycle looks set to continue for the near-term future. The UK had a troublesome quarter, with controversial fiscal policy around unfunded or debt-funded tax cuts leading to turmoil as the UK bond market sold off aggressively. This near collapse saw the BOE needing to step in with quantitative easing to calm markets and stave off havoc in the UK's pension fund industry. The UK pound weakened substantially and is trading at record lows against the US dollar, undoubtedly adding further pressure to the already high inflation in the UK. However, volatility remains elevated across most asset classes and regions, with the VIX or fear index increasing by 10% over quarter 3. Against this backdrop, local and global equity markets continued their sell-off, particularly during September, following on from disappointing inflation prints in August, leading to a further 75 basis points rate hike by the Fed and increased expectations of more to come. This has been the third consecutive negative quarter for developed and emerging market equities in US dollar terms. Year to date, the MSCI Developed Market World Index has sold off by 26%, and the MSCI Emerging Market Index by nearly 29%. Global bonds fared only marginally better and have not been the traditional safe haven asset class given the current rate hiking cycle. The dollar remained dominant as the risk-off sentiment played out, and the rand weakened by 10% against the greenback during this quarter. The strong dollar has, however, been somewhat of a silver lining, partially offsetting some of these large losses in global markets for South African investors. In fact, the decline in the rand over the quarter led to a small but positive global equity and global bond returns. Local growth assets were on the back foot during quarter 3, with equities declining by 2.4% and listed property between 3.5% and 4%, depending on the index. SA bonds managed a 60 basis points positive return, relatively better than most emerging market fixed income over the same period. Inflation-linked bonds contracted by just over 1%, and cash was king, returning 1.4%. With no place to hide, a strong downturn across growth assets, and mediocre returns from defensive asset classes, the Momentum Focus Fund of Fund range managed to offer some relief, with returns ranging from 0.3% to minus 1.1%, depending on the risk profile of the fund. One-year returns remain in positive territory, aside from the most aggressive Focus 7 Fund of Fund. Our local equity manager blend continued building on its successful track record of producing consistent alpha, outperforming the Capswix by 30 basis points during the quarter. Underlying managers Fairtree and Truffle contributed to outperformance, benefiting from strong stock selection and exposure to the energy sector in particular. The Momentum SA Real Growth Property Fund and the Momentum Flexible Fixed Interest Fund lagged marginally behind the All-P and the All-B respectively. Within the Flexible Fixed Interest Fund, Coronation benefited the most from its yield curve positioning, while Prescient managed to avoid any listed property exposure. Now, despite strong negative hard currency returns, the global equity mandates contributed positive returns in absolute terms, benefiting from the rand weakness. The Momentum Global Equity Fund trailed the MSCI World Index by 50 basis points for the quarter, but outperformed the index over September. The biggest absolute detractors in equity have been the mega-cap US names such as Apple, Microsoft, and Alphabet. Now, through our balanced style approach, we remain underweight to these names relative to the benchmark, and hence the positioning has improved our performance in relative terms over September. The Momentum Global Fixed Income mandate managed to end the quarter ahead of the index, as did our passive global property exposure. Over the quarter, we have increased our risk-off positions, with all growth assets now at underweight positions. We have added to our cash as well as our local and global bond exposures. Our preference, however, remains to local asset classes, particularly favoring local nominal bonds, which offer attractive yields. Additional currency hedges were also put in place, with 7.5% of the global equity exposure now protected against a reversal in the rand weakness, while allowing further participation in weakness up to the 21 rand to the dollar level. Given the growth, inflation, recession, and geopolitical risk, a cautious approach is currently warranted, and we remain defensive in our tactical positions relative to the long-term strategic asset allocations. However, with global markets down 25% year to date, some bad news is already priced into valuations. The local equity market is trading at a very strong discount to historical averages, and our local bonds remain attractive in the global arena. Earnings forecasts, however, warrant further downgrades, and we do not believe that terminal rates have been reached in the current hiking cycle. Therefore, we expect markets to remain under pressure. Thank you for listening.